the Shenzhen index up 23% in 30 days. Is that a good move, or is it going to end in tears?
That's a $10 trillion question. What you're seeing in China right now, of course, is in some ways perhaps a repeat of what we saw in 2015, which ended rather poorly. Now, we tend to see these types of movements fairly often, I suppose, in China. This is what some of us in the China watching world call the big, the great China moneyball, which just tends to roll around and it leads to a lot of speculation. It rolls from property to commodities to stocks and bonds. And obviously right now, it's been driven over to equities. And Beijing, of course, is doing quite a lot to ensure that sentiment is on the rise and it's positive and people are willing and able to invest into this bull market rally that you just mentioned.
If they wanted the market to really go up, and I'm not saying they should do this. I'm just saying if this is what they wanted to do, Shahzad, all they got to do is make it easier for guys like us here, wherever you are, not in domestic China, to buy Chinese equities. It's basically impossible without an intermediary to dip into the domestic Chinese equity market and, you can buy ETFs, but buy individual stocks. You think there's any chance that they would do that?
Look, I think, right now we're not heading towards that world. We're increasingly looking at a world where tensions between the two countries continue to rise and ultimately make their way into the financial realm. So rather than figuring out ways to let Americans or U.S. asset managers perhaps grab a larger share of the market, we might be looking at some of the opposite trends where it's increasingly difficult even for established companies to operate successfully on Chinese soil.
Yeah, I'll take it one step further, Shahzad, which is we've got American military assets that are steaming over to this part of the world, if not there already. A big naval unit, an aircraft carrier, a number of support ships doing exercises, all at the same time China saying, hey, don't sell missiles to Taiwan. The tension there is palpable, but the markets don't seem to care. By the way, our markets either.
Yeah, markets aren't factoring a lot of that in right now. And I think there might be a reason for that. At the end of the day, a lot of what we are looking for or waiting for right now is to see where does the president really go from here? As your reporter just mentioned, a lot of what's happening right now is heavy rhetoric, both from China and from the United States. But outside of a lot of the talk, you're not seeing too much action. And I think perhaps markets may also react once they see some kind of action, specifically, for example, what happens with the phase one trade deal. And that's, kind of what you need to be looking out for. There's another important factor there. Now, President Trump actually internally has been telling the Secretary of State and others to sort of calm down the anti-China rhetoric to the extent possible. He's focused internally. He's looking at what's going on with coronavirus here in the United States. He's worried about the economy, and of course, he's worried about his re-election campaign.